I'm Diane, I'm the CEO of Moneyline. It's really great to be here today and part of the conversation, so thanks for having me. As a not-for-profit lender, we are serving low-income households. We've been around for almost 20 years now, and we serve those households with more affordable financial products. Our organisation started using open banking data for underwriting in 2019 through our telephone lending. We embarked on development work on how we could use this and other data to formulate a kind of state versus trait views of our core customer segments. And that was really to improve our underwriting processes and extend almost that picture we had of our customers' financial lives. We accelerated that focus on the work during the COVID crisis. And we wanted to be able to see pre, during and post lockdown a kind of view of our customers' circumstances then to continue to lend responsibly to them in this period. We've discovered some challenges for our specific use case with the current structures of data, and we're exploring ways that we can tackle this, and hopefully there'll be the opportunity to talk a bit more about that today. The landscape for consumers is disrupted by how profoundly COVID has essentially changed your primary source of income, and consequently really your perceived risk profile either with mainstream and or alternative lenders. There are combinations of varying and layered circumstances. So people that were stuck in debt pre-COVID, that it's just increased and persisted. People that have incurred debt to navigate lockdown and beyond. Self-employed and gig economy workers with variable and precarious income, unemployed, either during lockdown or now with the end of furlough, entering the welfare system potentially, and people already in the welfare system whose income remained, I would say, fairly stable. It was more their expenses went up. Data, including open banking data, play an important part in finding the right solutions for those complex set of circumstances that I've described. And with increasing ability to do this in a more granular and tailored way is what technology affords. Now, that's true for many people in the system, but not for all people. So how you transact your financial life will determine how you can participate in some of the benefits of open banking and how well us as organisations can assimilate the data that they need to deliver that relevant and usable product that fits for you, will be where we can create success for our customers in terms of participating. We find that many of our low-income customers we see are not using their bank account as conventionally as a mainstream consumer might do. The way they choose to manage their money and pay for things leads to some difficulty in accurately categorising the transactions. We use the 12 months of open banking data to help get that wider view, where a customer is at the point of wishing to borrow and looking at that, what state are they in there? And then the trait, what are their usual financial characteristics and behaviours over a period of time? And what we're really looking for there is, are they in distress, or are they looking genuinely to cover and spread the cost of something over a period, and then taking a view on the how we should underwrite for that. Trying to build an income and an expenditure statement, so an I&E, from data has presented really three main barriers for us with categorisation of the transactions that are shared by the banks. Our open banking partners, they tell us that vendor ID, transaction code, and vendor address specifically are three things that are not included in the data set at the moment. So the categorisation is made using the transaction description, which can be variable between banks and or can lack information. So it's creating a gap really between what is being achieved and what could be achieved in terms of being able to categorise expenditure for people who don't necessarily pay everything by direct debit or paying their bills in a conventional way. So three main barriers. income related. If somebody's working part-time and they might be working part-time on a couple of jobs, small and variable income, for instance, for part working, being categorized incorrectly because of this often value thresholds placed on this transaction type, and it can mean that income can be missed in the underwriting assessment process if you're doing it all in an automated way. Secondly, cost related. Many costs and regular expenses are not categorized because of how consumers pay for them, as I've said. So if you go and top up your utilities at a post office or your local corner shop and use your PayPoint card, it's not going to show as specifically as I'm paying my gas bill or I'm paying my electricity bill. And we find several of those kind of fixed costs are hidden like this. And well over about 50% of our customers' household spend is still conducted in what I would call non-bank transactions in a significant number of the cases that we see. Finally, and probably the most challenging to solve, is transfers related. So a number of our customers use one account to receive their main source of income and then make transfers between another of other accounts. So they might be jam jarring money for bills or to contribute to bills that are paid by somebody else in the household. And without finding a way to almost subcategorize those transactions, it can make it difficult to, again, construct an accurate view of both the income and expenses. So lots of open banking providers tell us we have a lending dashboard for the INE for you, but when you actually drill down on some of the key parts, they don't work for customer segments at the moment, mainly linked to that variability on the categorization on the transaction description rather than the vendor ID and transaction code. So even with some very clever algorithms, and there are some clever algorithms out there, the structure underpinning the data actually needs to be extended to sharing those three other bits of information, in addition to the, almost what is the current scope and legal requirements for banks to share. So I think doing this create an opportunity. We're talking about financial inclusion today. It will create absolutely a greater opportunity for inclusion. It's got to be structured in the right way so that we don't leave people behind again with another kind of financial assessment system that's introduced. So yeah, that's the issue with categorization for us, and it's a really important part for us to be able to use open banking effectively.